So what changes would you be making to Australia's tax system and why? And let's see what, if any, we've doubled up on here and we'll have a bit of a chat about it.
All right, just to be clear, neither of us are going into politics.
No.
It doesn't seem fun. You know, normally I wouldn't bother talking about what I would do because we have no control over it, right? We're just going to play with the hand we're dealt. But this recent budget was really quite a significant overhaul. So it did make you think, okay, I really have spent a bit of time thinking about what I would do. Here's what I would do. If I'm running the joint, I want to incentivize work, investing in productive assets, starting businesses, because if you do that, you can afford strong social welfare programs, right? Like the current government, they're trying to raise more tax so they can spend more money. But you can't really do that sustainably unless you have a vibrant, growing, productive economy. Then you can afford to do all those nice things. So that's the background for this budget. First thing I'm going to do, there are some taxes that are going to go up. GST is going up from 10 to 15%.
What about low income earners in that one? Welcome back to the Winners Playbook. Josh here with Billy. It's felt like a little while since we've been on the podcast together, hasn't it, Billy?
A couple of weeks, yeah, like an eternity.
Yeah, well, we're back in here, and as usual, we're going to be diving into quite a few different topics. The hot ones today are going to be really talking around trusts, and there's been a bit more information come out with regards to what the government is proposing. There are still some things that we do not know, but there is a little bit more detail there that we're going to be diving in around trusts and, you know, what are the options going to be moving forwards? What does restructuring look like? And I suppose starting to think about into the future, what some of this may all be for those that are using trusts and particularly for business owners. And then we're going to actually finish with a hot take on what changes would we be making to fix Australia's tax system? So that's going to be interesting. We have not cross-checked each other's notes at this point in time either. So we'll react live on the spot and give some feedback, I suppose. But if we dive into the trust side of things, Billy, so, you know, what trusts are we talking about are excluded from these budget changes? And then talking in with that is companies are going to become more beneficial moving forwards. But if we just stick with the trust side of things first, so what are the trusts that are not going to be affected by these changes?
Yeah, so Treasury has released this consultation paper. They released it on 8th of July and they've given us until 31st of July to get feedback. It's not feedback on, you know, whether or not this tax should happen. Of course, it's feedback. They're asking for accountants to tell them how to make sure that everyone pays the tax or restructures properly. So in that paper, there's quite a bit of detail. They've excluded fixed trusts, disability trusts, charitable trusts, and they added testamentary trust to that got carved out a few weeks ago. So essentially it's really just discretionary trusts they don't like. They don't like people having the ability to decide each year who's going to pay tax on that income.
And then realistically then pushing, well, so we've got then say 1st of July next year is when all this is then going to kick in. And then from there, we've got, it's a 3-year window, isn't it?
Yeah, it's 1st of July 2028, so we're still 2 years off.
Sure. And then from that point in time, we can start restructuring at that stage.
Yeah, so as part of that, they've said there's this rollover relief, which means basically if you have a family trust, you can move all the assets to a different structure without paying CGT and so on. So the rollover relief window is July 2027 to June 2030. So it's a 3-year period of time you've got. If you have a family trust, you can move all those assets into another structure without being penalised by the tax office.
Yeah, interesting. Because I was chatting with someone just yesterday, a business owner, and they pre-budget had done a valuation on their business because they got it set up through a company, which is how most people generally start. And then they were looking at restructuring through a trust. So they'd actually paid for a valuation on their business. And then upon the restructure, there was going to be some taxes and things involved. And yeah, I don't know how at this point in time anyone would want to possibly be doing any sort of restructuring unless there was a real and clear beneficial outcome for doing it now. I don't know. I feel like you'd be a little bit crazy trying to do any sort of restructuring at this point in time, because if in that situation for that purpose, a person, if they were going to be doing it, they would be incurring some tax on the restructure through a trust when it's quite likely the trust structure may not even be beneficial for them all, for that individual person moving forwards. Because I think what most people are just going to end up doing at that point in time, which we'll dive a little bit into, is just put simply restructuring through to a company is what's going to happen. There's going to be a lot of new companies set up. And I think what will happen is most people who have structured it right already have their trading entity separate through the trust. So they're not actually operating through a trust, which I think is something the government does, play on a little bit and says people are operating and using trust, which we know is a very small percentage of business owners. Most business owners have their trading entity off to the side, and then there's them as a shareholder in the trading entity through their trust, but their trust isn't operating anything there whatsoever other than just holding the shares. And usually there might be, like in our case of Link Wealth, there's multiple shareholders and we all have our own individual trusts owning the shares in that business. So it's going to be very interesting to see how that unfolds. But one thing I found was very interesting around, certain widely held trusts, which are basically managed investment structures, but then also large superannuation funds getting caught under this. And one thing I found, which was quite interesting, which I know there is still more detail to come out around, was around the whole point, or not the whole point, the whole piece on negative gearing basically being abolished for the regular investor. Unless you're buying a new property, essentially, you will not be able to negatively gear property moving forwards. But what I've then found and what I've been seeing online is their exemptions are for negative gearing for new builds, but then for widely held trusts or large superannuation funds, call it Australian Super, Host Plus, you name it, they're still going to be able to acquire residential property, existing residential property, and essentially negatively gear it. So how do you make sense of that?
It's hard to know whether this is intentional or not. Like, is there actually a vision that big super funds become essentially a corporate landlords, like they buy a shitload of properties and you can find that your landlord is Hester or something. Like, is that where this is going, or is this just is it just like incidental? I don't know. Do big super funds want to buy houses? Maybe.
Yeah. Well, it falls into the argument of, I suppose for investment purposes, they think that's the best return on their capital, whereas maybe short-term, no. But there also could be, I suppose, if you're really getting your tinfoil hat on, if there's a real correction in some markets here, if you're a large super fund with billions of dollars there or hundreds of millions of dollars of cash to deploy, and you're seeing a 10, 15 or 20% correction, or maybe even more, probably in certain suburbs, is maybe you are sitting there on the side and you're licking your lips here, and this is a potential point of where you're going to get in and start scraping up some residential property and still negatively gear.
I don't know. It's hard to imagine super funds wanting to buy existing individual houses. You'd think it's more geared towards, they're going to develop properties, which they already do a bit of. But it's interesting that that's been carved out.
Yeah, well, we'll wait and see how that one unfolds, because there's got to be a bit of uproar around that, because it really isn't, doesn't sound like a fair system whatsoever if the everyday Aussie can't do it. But then, being a large superannuation fund, you can, I suppose they could then argue that, that's going to benefit the everyday Australian because that's where their retirement savings are sitting. But I think there's more to it. I think there's definitely more to it. And going back to, with the rollover relief, I guess the big question and a little bit of an unknown at this point in time is, if you use a pretty common example, which would be even say for us at Link Wealth, where you have, trading entities, you then might have a commercial property in the structure there as well, or in the group, if you want to call it that. There's a little bit of an unknown at this point in time around this whole restructuring rollover relief, and that it all looks like you're going to be able to convert from trusts and basically pay no CGT. It looks pretty clear that that's going to be the case. And so everyone's going to be, like we said earlier, rolling into companies. But then if you've got property assets within your trust structure, there's a question mark around what's going to happen with stamp duty. So what are your thoughts there?
Yeah, well, that's what they didn't even mention that in this consultation paper. They've said the rollover relief is quite significant. So you've got essentially a 3-year window where if you have a family trust, you can move all the assets of that trust into another trust, into a company, into individual names. Like, you've got a lot of flexibility. They have not mentioned stamp duty, because stamp duty is a state-based tax. So they would need every state of Australia to say, yes, we'll also give these people who are doing this rollover relief, we'll give them a break on stamp duty as well. Well, we're in Victoria. We've got a serious slowdown in housing here. So Victoria's already looking down the barrel of a lot less stamp duty collection this year.
Yep.
So are they going to be happy to give relief to all these people restructuring, or are they just going to say, no, bad luck. If you want to move from a trust to a company, you're going to have to pay stamp duty again. I don't know.
Yeah, and it's, what is it? Is it going to be your sort of one or all thing? You like, you have to, all of it has to restructure, or
It does. So it specifically said everything. You can't cherry pick assets.
Yeah.
If you're moving out of a family trust, you want rollover relief, it's going to be all the assets of that
So
trust.
all or nothing.
Yeah.
Geez, that's brutal. That's pretty brutal.
And it has to be the same people. So you can't, like if it's in one family group, you can't have different individuals or different beneficiaries under the new structure. It needs to be like the same people that benefit from those assets.
That feels really harsh, because you think a lot of business owners probably made up optimally structured from the get-go, and they might have everything wrapped under, the one entity. I suppose if you've gotten some advice, you might have some different trusts and entities. So maybe you could just leave the property trust alone, but then, restructure the other trust with the other assets in. But if you've got it all wrapped underneath the one trust, which a lot of people will, then you could be possibly forced to incur hundreds of thousands of dollars by way of stamp duty, because, commercial property is generally going to be quite a lot more expensive than your average residential property. And if you've got a multi-million-dollar commercial property structure in there involved, like that could be, if there's no relief amongst that could be just money burnt down the drain by way of stamp duty. And if you would think, if that was to happen in that sort of fashion, it's pretty disgusting, to be honest. That'd be
there's a lot. It's important to note none of this is actually law yet. Mm-hmm. So and that's why they've got this consultation paper, because this area is so complex.
Yeah,
like our mate Harry Dell, he said earlier on, there's no way they're going to have a go at trust taxation, because it is so complex. It's an absolute minefield. Mm-hmm. And we're seeing this now in this paper. They said, for an example, here's an alternative idea. How about if we allow a family trust to make an election to be taxed as though it is a fixed trust instead of restructuring? Mm. So this is Treasury saying they don't know either. They're putting it out there to all the tax lawyers and accountants saying, what about this? What about this? Because they don't know how to implement this without leaving all sorts of loopholes and grey areas and questions. So to your point, now is not a good time to restructure.
Yeah.
Well, I guess we've got time. So.
Yeah. Well, I was going to say, shout out to all of the accountants and fighting the good fight, who are probably in there slugging it out with the government in this consultation at this point in time, trying to figure out how to make this. And you can only hope common sense prevails here, but we'll see. We'll see what happens. But staying with that just for a moment before we move on. So then most people are likely going to end up in company structures, which I guess, why is that beneficial? If it's a base rate entity, you're deemed as a base rate entity, which is essentially if you're any kind of trading entity, you're taxed at just 25%. So it's actually pretty simple once you're over in that structure. The only issue there being is the distribution of profits is then a fixed entitlement, essentially, to the shareholders of the business, which means you don't have then discretion around sending any of that money out in any other way, shape, or form. Other than that, I know I have seen and heard of accountants talking about implementing different classes of shares and going down that route. So what do you think around getting a bit creative there, and what have you seen?
Yeah, well, like as soon as this trust tax thing was announced, immediately, of course, you're going to problem solving. What about this structure? What about that? And we saw a couple of accountants say, well, you could just use a company and you can have different classes of shareholders, because once you have different classes, you can pay dividends to some shareholders and not to others, and so on. So you've still got like discretion, essentially. Mm-hmm. In this consultation thing, they've said, no, that's not happening. Like just flat out. They've specifically said you cannot restructure into a company where there's different classes of shareholders. So they're basically saying there can't be any discretion each year around which beneficiaries get that taxed on that income, no matter what structure you move to. So that's pretty much been shut down.
So you're saying that's very good?
No good.
Right. Back to the drawing board we go, and I'm sure accountants are already doing that. But if we talk about the actual conversion then of trusts, it sounds quite simple, converting from a trust to a company, but it's actually not. There is a lot that goes on, and I just wanted to rattle off a few of these points to consider, which the amount of tax and compliance and accounting work that's going to have to be done to administer all of this is going to be ridiculous. So maybe some accountants are licking their lips because this is just throwing so much work at them that they're going to have to then get done. But as a starting point, hear me out on this. So what do we need to be doing if you're going to be looking at this? So you're going to be reviewing a trust deed any of your existing structures, identifying every asset, liability, and contract, establishing the replacement company or a fixed trust, as we were referring to before, possibly determining whether the proposed federal rollover applies, transfer the business or assets, review state stamp duty consequences, obtain lender and bank approval. It's going to be another big one, because if you're restructuring through to different entities and you've got loans, the bank's going to be all over that. Issuance of new documents. We've actually been through that before. Transferring employees and employment obligations, assign leases, licenses, contracts, insurance, deal with existing trust loans, unpaid present entitlements. I see that a lot on people's financials with their trust. Reviewing Div 7A implications, because it'll be interesting on that one when you are sending money out or getting into that Div 7A territory. If you're actually lending money from company to company, Div 7A requirements don't actually apply. So that will be interesting to see how that plays out there moving forwards, because then you could have more people shifting money from one entity to the other and not having to go through the same Div 7A problems that would arise if they weren't doing it from company to company. Updating the succession arrangements, estate planning documents, potentially retaining or ultimately winding up the original trust. There's probably more, but there is a lot to unpack there.
That's wild. I mean, maybe that's why they've said there's a 3-year window.
Yeah.
Might have to be a 7-year window or something. But yeah, I mean, it's crazy. Like, we've gone from, I heard rumors of like, accounting, like being an accountant is one of the things under threat from AI. And that's, well, there's going to be at least 5 years of just a ton of work here just on this one thing.
I agree. Yeah, I agree. And I've got some clients with some rather complex structures with a lot of entities involved. So you can only imagine the administrative burden on restructuring and relooking at all of that. So that's definitely going to be fun for our accounting friends, which we'll be working very close with, of course, in and amongst that. But moving over to then franking credits. So I haven't heard a huge amount of talk about franking credits on social media and in the news, but franking credits are in the firing line here, particularly for trusts, of course. So what have we got to worry about there, Billy?
Well, Bill Shorten tried to get rid of refundable franking credits, if you remember. And he didn't. He tried to kill negative gearing and no refundable franking credits. He didn't win that election, so that got put on the back burner. And with this latest budget, they haven't mentioned franking credits. Probably because I think it's a toxic term to even mention, because people will remember that. But the skeptic in me says, if they manage to get all these changes through and they force everyone to operate through companies, step 2, let's go after refundable franking credits, because that's the other big tax minimization strategy the business owners use.
Yeah.
You accumulate profits in a company, and you choose not to pay dividends until down the track when your taxable income's low. Then you pay some dividends and you might get tax credits that are refunded to you. So I feel like that will be the next thing under attack. But even in the short term, just with these trust changes, there's issues with franking credits there as well, because these changes essentially say for a family trust, the trust needs to pay that minimum 30% tax, right? Then the beneficiaries of the trust get like a credit for that tax that's being paid. So what happens to franking credits that flow through that trust? That's not clear. And in this paper, they've actually said, we don't know what we're going to do with franking credits. And so we think it should be used to offset the beneficiary's tax bill, but what if there's leftover franking credits? Are we going to allow those to be refundable? Or should they be carried forward, or what's going to happen? So just another little layer of complexity.
Well, it's worth noting, like, a lot of retirees generally do rely on franking credits. And I suppose if someone has built up some wealth through trust, they'd be very worried about this one, because usually in those years of retirement where you're not working and generating income through employment or your business at that point in time, that's usually where you're getting all these refunds on franking credits. And if you use a very simple example here, let's just say a company earns $100. Say the company pays $30 by way of tax, which is the highest tax company tax rate here in Australia. And then in this situation, the company pays out to the trust a $70 cash dividend, okay? And then how the franking credit system would currently work is, okay, $70 in cash would then go out to the trust, but then that would be accompanied by on paper, $30 franking credit for the $30 tax that has already been paid. And then what happens in that scenario is the cash received by the investor, or let's just say the trust and the beneficiary, that's taken, and then a franking credit is added on to that to determine the total amount of tax paid. So let's just say the beneficiary of that trust would be assessed on getting $100, $70 by way of cash, $30 by way of a franking credit. And what would happen in this scenario usually is if you're then below, say, a 30% tax rate in this scenario, because you're not working, you would essentially get a refund on the franking credit, depending upon, again, how much income you're actually earning here. So let's just say if the beneficiary's tax liability was only $15, well, right now they would currently receive the additional $15 in their franking credit back as an actual like cash payment, essentially in their tax return. However, under the proposed changes here, like you're saying, Billy, that's basically going to be lost. So if you're on a lower marginal rate than 30%, essentially the franking credit could possibly be lost in this scenario, which is not great, because the whole idea of that franking credit system is to avoid double taxation in the first place. And yeah, I suppose we don't even need to get into bucket companies, which I don't know if anything more's come out around bucket companies, but they seem to still.
They reiterated that that's gone.
So they're dead, well and truly destroyed. A good old bucket company. Yeah. So yeah, it's interesting. So it's going to be hopefully they don't go a step above and beyond what we're saying here with regards to trusts with franking credits. But realistically, if you're not earning assessable income or your total earnings aren't over $190,000, you're virtually going to be losing your franking credits if this all goes through. So, retirees, if got wealth in trust, that's going to hurt a lot. I suppose if you're still earning income over 190, at least you're going to get the use of the franking credit, and you won't be double taxed. But not a positive announcement there. Anything more, Billy, before we move on?
No.
All right. So, Billy, in closing, we're going to get into we're going to put our political hat on here in a way and pretend that we are actually in power, which I suppose we are. We don't praise people. But so what changes would you be making to Australia's tax system and why? And let's see what, if any, we've doubled up on here, and we'll have a bit of a chat about it.
All right, just to be clear, neither of us are going into politics.
No.
It doesn't seem fun.
Well, didn't Trump say originally? He did say originally.
I think it took him a couple of decades to come to. Yeah, I mean, normally I wouldn't bother talking about what I would do because we have no control over it, right? Mm-hmm. We're just going to play with the hand we're dealt. Yep. But this recent budget was really quite a significant overhaul. So it did make you think, okay, I really have spent a bit of time thinking about what I would do.
Yep.
All right, so here's what I would do. If I'm running the joint, I want to incentivize work, investing in productive assets, starting businesses, because if you do that, you can afford strong social welfare programs, right? Like the current government, they're trying to raise more tax so they can spend more money, right? Which is fine, right? Make it easier for people who need help, etc. But you can't really do that sustainably unless you have a vibrant, growing, productive economy. Then you can afford to do all those nice things. So that's the background for this budget. First thing I'm going to do, there are some taxes that are going to go up. Mm-hmm. GST is going up from 10 to 15%.
I had that. We're on the same page.
You have to, right? And it's one area where Australia's tax rate is very low compared to most countries. So that's a no-brainer. And it's so easy to do. It's not complicated. Mm-hmm. The tax is already there. You're just changing the rate. That's going up to 15%. There'll be some compensation for people on age pension and things like that because their costs will go up a bit. Mm-hmm. So you might increase their payment a little bit to help pay for that.
What about low-income earners in that one?
Yeah, we'll get to that.
Okay. All right, jump the gun.
So we're going to push up age, pension, disability payment, job seeker a little bit to help, so make sure they're not out of pocket. Yep. Now, usually GST flows through to all the states, but I'm going to tell the states you're not getting this revenue unless you make it easier for people to build houses, for property developers, and you make it easier for businesses. So I want to see lower payroll taxes. I want to see less red tape and taxes on property developers and people building houses. If you do that, you can have some of this GST money. We'll tax resources more effectively. That's probably a whole rabbit hole, so I won't go into that. But we don't collect tax well on resource exports. Australia needs cheap energy to be successful. So that would be a whole separate focus. And then overall, the government needs to cut spending. The size of the public service has ballooned, so we need a smaller public service. So I would shrink the overall size, crack down on NDIS. It's full of corruption, right? So there's plenty of dollars to be saved on that. And then there's some crazy big infrastructure projects which are being rorted and just a total waste of money, like the rail loop in Melbourne. So that's where we'd save money. Mm-hmm. we will substantially lower income tax. That's the problem, right? You go out and you work your ass off, and as soon as you earn a decent income, half of it's off to the tax office. We're becoming very uncompetitive because of how high our income tax rates are, and that's making it harder in terms of cost of living. So we're cutting income tax across the board, all tax brackets. The top rate won't be 47, it's going to be 40. And it's not going to kick in at 190. It's going to be like double that.
Yep.
Income tax is a cut. Instead of increasing the minimum wage, we're just going to increase the tax-free threshold. Because at the moment, the government goes, how good are we? How nice are we? We're increasing the minimum wage. They know businesses have to pay for it, and they get to tax the income. Right? So it's self-serving. But if you just increase the tax-free threshold, then low-income workers keep more of their money. And then last one is we're going to lower capital gains tax. So we might increase it on existing houses, because we see probably the problem there, that people are going a bit crazy buying negative geared properties. So we might increase CGT there, but we'll definitely reduce it for small and medium-sized businesses and their shareholders, because we want to encourage businesses.
Nice.
That's it. Are you voting for me?
Probably. Maybe put you in charge of the Australian equivalent of Doge. Doge.
No, don't compare me to Trump, please. But
what's it? The Doge, that's Department of Government Efficiency. That sounded pretty efficient.
It sounded good. It didn't work.
No. Well, yeah, I think we had
have I covered everything?
Yeah, we had some crossover points. So maybe I might start with those to begin, because I definitely had the income tax brackets in focus, but I was thinking more around, the whole conversation around bracket creep. And, inflation is going up. Tax brackets haven't changed forever, basically. There's been some, small changes over the years. So I would want to then look at, at least addressing the bracket creep scenario. So the tax brackets will at least be going up with inflation year on year. But I would even possibly look at backdating a little bit of that, because it's just those just have not changed for such a long time, which probably ends up in a similar way to what you were thinking about with, lowering the income tax rates to, top margin rate of 40%. So I think we're on the same page with regards to that. I didn't have the one, I had around GST for sure. So I had that going to 15% as well, because really that's a tax on consumption. But I guess the worry around that one, and also income tax is a tax on productivity and earnings. But then the worry there being, okay, if you look at that as an even playing field, then the low income cohort does get hit quite hard if you don't address that, because you're increasing the consumption tax and you're going out buying groceries and all of these sort of things, and everyone's paying the GST. So I think that would then be balanced with, possibly increasing the tax-free threshold, quite possibly lowering or putting in some other form of measures for lower income earning households. But I had exactly that with GST as well, and I really do like the idea of, for the states and making them really work.
Hold it to ransom.
Yeah. I like that on payroll taxes for sure. But me diving a little bit deeper into, creating that incentive for investing, I suppose, back in Australia, and innovation in Australia is really, really my theme. So increasing the incentives there to invest in, Aussie companies, because we were talking about a little bit earlier, and I heard some takes on this recently around, particularly Australia's, we've spoken about it a lot. Like, they have this lust for residential property and buying property. The amount of politicians that have negatively geared property, which no wonder why they want to grandfather those rules. But when you think about property investing, and I am a fan of property investing, I'm not opposed to it at all, but it doesn't create really any value. Like, what value does it create for the Australian economy? It doesn't. Like, it really doesn't create any value there whatsoever. So what I'll be wanting to push for from that regard is, I think some of the changes for negative gearing, positive longer term. There are some positives associated with it, but I would want to get more of that investing, encouraging more investing, maybe leaving some of what they've done here for property, but then making the appeal to invest back into Australian businesses a lot more appealing. So, with all of the CGT changes and just whacking basically all assets, I think I'd be looking, harder at that, because if you look into some of Australia's biggest companies, some of those are 70, 80% owned by foreign ownership. So I think we need to get more Australians investing back in Australia and keeping, those dividends and all of that income onshore. So that would be a key part of my focus there. Would be really trying to push the incentives for everyday Australians to be investing back into, Australian companies, not necessarily just residential property. And then going, with business owners, I think is the biggest one, is just really looking at, how can you up the incentives there for Australians now to, want to actually have a crack and innovate and start a business here in Australia and take on those risks? And, how does that look and feel? It's got to have to do something with the tax rates. Like now, whereby, previously, if you sold and you're one of the lucky few that make it and you sell your business for a decent amount of money, as of right now, I suppose, or with the pre-rules here, you would have been taxed at 23.5% on the gain, essentially, which is a rather low tax rate. Whereas with the changes that are now coming in as a business owner, or you've had a successful business, you could push up close to 47% by way of taxes on the gain. So you risk everything. You mortgage your house, you get the business off the ground, most naturally fail, and then you're looking down the barrel of losing half of your gain towards the government. So that would be a massive no-no for me. And I'll be looking very heavily at what other incentives we can push in to, give business owners more incentive just to invest back in their business. Payroll tax is a massive one, but what other incentives that, we could be doing? I guess give the business owner more control over their business. And I would be wanting to ensure, maybe my ransom with the GST would be telling the states to pull back a bit in terms of how involved they're getting in businesses and telling businesses how to run. Use our state of Victoria.
You're thinking about work from home, aren't you?
I am. So use the state of Victoria as an example with some of the proposed work from home changes, which I get the idea of it, but then forcing the businesses to basically pay to set staff up from home. Some of that stuff is just so backwards in my mind. And then you think of some of these younger generations, you miss out on so much by not being in the office and around all of that experience. So I think it's a shorter term, solution. It's going to create a bigger, longer term problem. So I guess that's a bit of my rant, Billy. So we had some crossover amongst that, but what do you think? Any Christian?
Sure. Well, yeah, I mean, just, I get stuck in the comments sections on our social media pages, right? And people hear that and they go, yeah, but I don't have a business. I don't want to run a business. Why do I care about business owners and all these things you're saying? It doesn't help me. Well, if you get this right, it does, because the problem one of the main problems in Australia is we have this constant inflation. We have big corporates. We have like the supermarkets where it's a duopoly. Like they're all ripping you off. They all control prices. So you need a strong private sector. You need strong small and medium-sized businesses. So there's lots of competition. There's lots of choice of jobs. Like you need all of that. That's how you get cost of living and cost of housing under control, is to have a vibrant startup, small business, medium business community, lowish taxes, less taxes on property developers and home builders. If you make all that stuff easier, you will kill off inflation, in my opinion. And that helps everybody, because inflation's hurting everyone at all income levels at the moment.
Yeah.
That's my view. Anyway, I don't want to get into politics.
Yeah, no, I agree. Well,
I found it irresistible with this latest budget, because it's such huge changes and it's like all the wrong incentives that they're going after.
Yeah.
So yeah, we had to speak up.
Yeah, I think it's quite easy. We can sit here and kind of cherry pick, because like one even for me, which I didn't have it right down here, but in terms of just fixing the overall system as a whole, like I would actually look at trying to expand the parental pay system, and even looking at if you can pull back some of this spend around NDIS, infrastructure projects, and all the waste that happens there, which you're never going to get rid of entirely. That's how society, I suppose, is. But if you could pull back in some of those areas that balance the books a little bit better, I would be trying to, just being like a newfound father and like going through that experience and seeing it, putting more incentive back to pushing out that parental pay system and maybe expanding it for longer. I know there are some countries that have a year or two actually paid parental leave at home, because I think there would be, how many of society's problems today from the young generation are coming from parents just not having enough time to invest in their kids and being forced back into work so soon because you got to get the income coming in. So if I had some budget surplus to play with in my imaginary government, I would look harder at expanding that out and giving more benefit back to the households there to spend more time actually with the kids, because I think in those earlier years, that's critical time that the parents need to be spending ideally with their kids, and not necessarily having to rush straight back into work, unless they want to, of course, if they want to, but give more incentive back to investing in that next generation, because they're the future of Australia.
That's it. So governments can't afford any of those things if they don't have growth and prosperity.
Mm-hmm.
And at the moment, like if you just keep layering on more taxes, more complexity, and that's all you're focused on, you're not going to get that. And you won't be able to afford programs like that.
Yeah.
So yeah, I think we're on the same page.
Yeah, well, I think with it as well as you know, the problem is like how the system is built and how much time you have in place, and you just want to get in and sort of spend money, but you're not really addressing any of these real problems because you're so worried about just kind of keeping power for the time that you've got, and you know, you don't really have a long runway to make a lot of these changes, because these changes all sound good and well, but like they're not going to happen like that overnight. They do take time to actually roll out. But hey, we'll let the listeners be the judge of the link wealth edition of Doge and making Australian government great again with those tax system changes. But other than that, Billy, I didn't have any other final notes. Any other closing remarks on your end, mate?
No, I think we're good. And we invite any listeners who listen to our rants to give us their 2 cents on how they'd run the place.
Yeah, I agree. I'd love to hear from others. But yeah, I hope you are getting value out of what we're talking about. And as always, 5 stars on Spotify and also Apple if you are listening, because it does help us out a lot. And until next time, we'll see you there. Thanks for listening to the Winner's Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.